Hey everyone, I hope everyone is doing well and had a good day. And in this video, I'm going to review the Emini 5-minute chart for Wednesday, September 24th, 2025. And I want to talk a little bit about the past couple of days, at least on the daily chart. I actually did not trade today. I have not traded at all this week. I'm getting over a cold, and the screen was just too much for my headache. And up until today, it kind of hurt to talk, so that's why I haven't really been posting any videos. I want to talk about what's going on here on the daily chart. So this was Monday, the 22nd. So this is what we had going into the week. I talked about how the market has been in a bull trend for a lot of bars, since even down here. But it looks like a strong new breakout here, maybe a measuring gap, tight channel, pullback. We're in the channel phase, and the market's breaking out above the bull channel line. In general, most of the time, channels evolve into trading ranges, which means a bull channel is effectively a bear flag, meaning you usually get the bear breakout of the bull trend line, not the bull breakout of the bull channel line. And when you do get the bull breakout of the bull channel line, 75% of the time, the breakout fails within about 5 bars and reverses and then tests the trend line. So that's generally the expectation here. The market's been in a bull trend for a lot of bars, breaking above a channel line. And then look at Monday's bar. Look at the daily chart bar. It's a big, strong bull trend bar, maybe one of the biggest and strongest bars in the entire channel. And that always there needs to be like an alarm going off in your head telling you this is suspicious. Why are we suddenly getting the strongest, one of the biggest and strongest bars late in the rally? That's a warning. There's a couple problems with that. The one I already mentioned, this is a low probability event. Only about 25% of the time, this breakout will succeed in accelerating the trend into an even stronger trend. But more often than not, 75% of the time, it's going to fail and reverse and then come back and test the bull trend line. One of the problems with this bar is the trader's equation. Big bar means big risk. So you're forced, if you're going to buy the close of this bar, stop below the bar, risk is big. You're buying far above the moving average, so you're buying far above the average price. You're buying what's, again, late in a trend, breaking out of a channel line. You can count 3 pushes, 1, 2, 3, and all of a sudden you get the biggest bar, big, strong bull trend bar. The problem here is that it might be a bull trap. It might be trapping bulls into buying too high. And then when you get the next bar, it's a 2-bar reversal. So on a time frame higher, these 2 bars make up a reversal bar, opening here, rallying to the high, then coming back, and now closing near its open with a big tail above. That's disappointing for the bulls, and based on the circumstances, the context, it's probably better to exit any longs below the bear breakout bar, the bear trend bar, rather than holding on to your longs and basically waiting to scale in. It's probably better to exit longs because the pullback can be a lot deeper than the bulls want, and this could be evolving into a trading range. When you get a bear bar under these circumstances, bull breakout of a bull channel, 1, 2, 3 legs up, late in a bull trend, and you get a bear bar closing near its low, it's kind of a default exit. You're far above the moving average. Just get out, because we can easily at least test the low of the third leg. 1, 2, 3. The start of the third leg is a magnet. The moving average is a magnet. The trend line is a magnet. So the market can go lower. And if you think the market's going to go lower, and the odds are that it will, then it doesn't make sense to stay long or to buy here. It makes sense to exit longs and look to buy lower. If that's the case, then it makes sense to sell. And then here's today. So we got the entry bar for the bears. So going into the day, the expectation for me probably not many traders willing to buy directly below yesterday's low. Maybe they bought below Monday. It's a strong signal bar, but the entry bar was disappointing, closing below its midpoint. If you're buying below a bull bar, you generally want the entry bar to close above its midpoint. Let's see if there's an example. Maybe I'm missing one through here. This one, it's a bull bar. It's a little bit different. It went far below the prior bar, but it then reversed up, closing well above its midpoint, closing near its high. Let's see. Not seeing a great example. But anyway, the point is this was a disappointing entry bar for limit order bulls who bought below Monday. This is their entry bar. It's disappointing. Like I said, if traders are expecting lower prices, they're not going to hold on to longs. They're going to exit and look to buy lower. And this is a bad stop order buy signal. It's basically, there's probably sellers above yesterday's high. If you think about stop orders only, would you rather buy on a stop above yesterday's high or sell on a stop below yesterday's low? It's probably better to sell based on the context and the signal bar alone. So as far as today, let's talk about the 5-minute chart. Small gap up going into the day. And look at the context. Yesterday we had a bear trend day with the vast majority of the bars being basically completely below the moving average, only getting above the moving average for several consecutive bars late in the day. And actually, let's go back to Monday. What happened through here? Really strong rallies, strong bull trend here. But what's interesting is every strong breakout, every strong rally, you never know how many dollars, how many institutions have orders to sell above the market on the higher time frames. You don't know how many dollars are waiting to sell. So this could be a vacuum test of resistance. And I said it's a strong breakout bar on the daily chart, but it might be a bull trap, trapping bulls into buying too high. Risk is big, context not very good. Basically, it's a momentum trade. And if the bulls are buying here, their premise is momentum. And if they're not getting momentum, then it's hard to justify taking the trade and buying up here. So going into the day, finally got a trend line break. Here's a bull trend line. Significant break of the trend line. Big bear bar, big, small, big. That's a significant trend line break. Bars completely below the moving average. But for a major reversal, we need a test of the highs, and then maybe the bears get a lower high, major trend reversal. And that's ultimately what happened here. Evolved into a trading range after the trend line break, tested the highs, found sellers at resistance. Here's resistance up here. Bulls trying to get back up there, but after this breakout, it's now a trading range. Traders are buying low, selling high. Traders who bought over here got trapped. They're looking to exit, and we got the major reversal. So we broke below the trading range. Maybe this is the low of the trading range. We broke below it here. This needs a second leg down, and the breakout grew. Minor reversal going sideways, probably sellers at the moving average. 40 breakout bar, but it's 2 legs up against a strong trend. It's basically a low 2 in a bear trend. 40 is a sell the close bar. Low 2 signal bar, 41. Okay to sell below. Trend continues. And then acceleration here. So a lot of selling. This is another probably minor reversal. But it's continuing into today. Now this is a trading range. One thing we know about trading ranges, in a trend, the trading range is more likely to break out in the direction of the trend preceding it, so more likely we get the bear breakout. But this is enough of a trend line break here that it's possible we get a major trend reversal. So it might be closer to 50-50. Maybe there's a slight probability favoring the bear breakout, but after this much buying pressure and this deep of a pullback, it's probably close to 50-50 for the next breakout direction. But trading range going into the day. But look at the price action on the open. 3, 4, 5 consecutive bear bars and a strong breakout crossing the moving average. It's early. This is the only feature of the day, but it's a dominant feature of the day. This needs a second leg down. Very likely that the first reversal will be minor and we'll get a second leg down. We'll probably break out and test the low of yesterday. So this is probably a minor reversal. Traders will sell and scale in higher, knowing that the odds are good that they'll get a second leg down. Low 1, low 2, bar 10 to sell the closed bar. Low 1, low 2, low 3. You can call it a low 4. It's a bull channel after a bear breakout. Bull channel, bear flag. Second leg down still likely. So 1, complex pullback, probably get a second leg down. And the second leg down is a tight channel. Might actually be a breakout. I'm not sure if we pulled back here. We did pull back here, but is this enough to buy? It's a double bottom, maybe a nested double bottom. High 1, high 2, and a double bottom with 66 and 22. But the entry bar is smaller than the signal bar. This is tight enough for at least a small second leg down. You're testing resistance. You're right at the moving average. So if you're buying here, you're buying right at resistance. Not ideal. And then strong resumption down again. So maybe it's a second leg trap, low in a trading range. Traders will buy here. 1 pullback 2, 2 subdivided into 1 pullback 2, low in a trading range. The danger with buying here is that it might still be a bear trend evolving into a more broad channel. So obviously a really tight channel down to here. There's a risk of buying right here. But until we break strongly below yesterday's low, traders will buy here. But this is where it's important to think about limit order traders. A limit order bull bought the low of yesterday, and they got trapped on bar 28. 28 is a strong breakout bar. It's closing on its low, closing below many bars to the left. It's an above average size bar. So this might reset the leg count. This might be a measuring gap. So it's possible we fall for a measured move. The first target from here to the breakout point, and that takes you close to the channel line. So this is a reasonable target. And the bulls, they know they're trapped, and this probably needs a second leg down. So they're probably going to wait for a couple of legs down before they look to buy again. Pause bar 29, but it's a weak buy signal. Probably sell the close and sellers above. And then 30 got to the channel line in a hurry. Now, big breakout, pause, another big breakout. This and this over here, this is not as strong as it gets for a trend. It's kind of like, if you think about it as a spectrum, and -1 is as bearish as it gets, 0 is a trading range, and +1 is as bullish as it gets. Price is always on that spectrum, going back and forth between bearish to trading range to bullish, back and forth. But it can never truly be at a -1 or a +1. If it gets too bearish, then it attracts profit taking. This happened over here. This is this is as strong as it gets, or it's an example of kind of small pullback trending behavior. It's not too climactic, but once you start getting this and this is very climactic. You're getting very far from the moving average. It's hard for the bears to justify selling down here when the risk is so big and they're selling so far below the moving average. So What has to happen? The bears start to take profits because the risk is just too big. They have to reduce their risk, and one way to do that is to reduce their position size, and the way you reduce your position size is to take profits. So bears take profits, and that contributes to the buying. Bulls are always buying, and the bulls are buying, betting that this is overdone. It's too far, too fast. It's a breakout of a channel, and it's far below the moving average. So the bulls are buying value down here. So as soon as there's an indication that the momentum is slowing up, the bulls will start to buy. They might not buy straight on the bear trend bars, and maybe they will, but maybe they'll wait for the trading range bar 51, the bull bar 52. The bulls will start looking to buy in here, and the result is a trading range. And so that's what I'm kind of saying over here, that these big bars for the bears are problematic because they attract profit taking. We're testing support. It's big bars far below the moving average. It attracts profit taking. It attracts value buyers. So bears have a great price to take profits. They need to reduce their risk anyway, and bulls start to come in. Maybe not necessarily right here, but if we start to pause, start to get more overlap, the bulls will start buying. The risk is too big for the bears. We can pull back more deep than the bears want. Remember, this could be a broad channel now, where the pullbacks last several bars, maybe 15, 20 bars through here, and it's pretty significant to the point where it might be always in long, and that could be happening here. It might be transitioning to always in long based on context, not necessarily price action yet. And then a strong breakout 35, probably always in long, second leg up likely. We might be near support in a broad channel. So this needs a second leg down, but now the pullback 34, 35 needs a second leg up. So both sides need a second leg, but the bulls will probably get their second leg first. This is probably the pullback of the pullback, meaning bear breakout, pullback, and then this is probably not resumption and a second leg down for the bears. This is probably the pullback of the pullback being 34, 35, then a complex two-legged pullback, and then probably more to the upside before there's an attempt back down. So there's the bulls' second leg. But we're testing resistance in the second leg now, so there's probably a limited upside for the bulls. Bulls getting 1, 2, 3 legs up. Strong reversal bar outside down. This is a reasonable sell. Second leg down likely, and it might be the start of a big second leg down. 1, complex pullback, and then maybe 2. But this is probably a trading range at this point. It's still a lower high. It might be a broad channel, but a broad channel is to be treated as a trading range. Buy low, sell high. And scalp, I didn't mean to delete that. So as far as buy low, sell high, and scalp, the channel line is where you buy low. The trend line is where you sell high. It's not perfect. Obviously, we're not there. We're not at the trend line at this point, but we're testing this breakout point, the low of yesterday. We're testing bar 30, broke out here. So we had range expansion, range contraction, range expansion. So that's a breakout. Trying to break above it, failing, trying again, failing again. And it's likely we test the lows. This bear breakout is probably going to get a second leg, probably going to test the lows at a minimum. Strong 3-bar micro channel, second leg down likely. Context is more bearish, good for the bears. Sell above 53, sell below 54, low 1. Bad buy 57, probably sellers above. Smaller entry bar, if you're buying 58, you're forced to buy right below resistance, the moving average. This is a tight channel, needs a second leg down. Low 1, low 2, probably sellers, probably disappointed bulls who bought 58, looking to exit. You can see the reaction on 61 getting close, selling off. Big bar or bigger bar 62, but it could be a second leg trap. 1, pullback. 2, and on a smaller time frame, this is a 60 through 62 is a bull channel. Rally, pullback, rally, pullback, rally a third time, so a third push, and it's a breakout of a bull channel line, and the context is bearish. Leg 1, complex pullback, probably sell the close 62 and get a second leg down. I want to show that in this case it hesitated. We got a third push, maybe 1, 2, 3, 65, also a sell the close bar, breakout of a channel line, small follow through bar, testing breakout point here, 48 low, several breakout points getting tested, expecting sellers above and a second leg down. And then a strong breakout bar, 67, second leg down. It's similar to 50, where you have this big leg down, a complex pullback, and then a new leg 1 that is maybe the start of a big leg 2. Same thing here. This needs a second leg, complex pullback. 67 needs a second leg, but it could be the start of a big second leg, 1, pullback, 2. These are bad high 1 signals, weak signal bar, good context for another leg down. And there's probably sellers above, trapped below 66 and above. So these are sell to close bars. Bears not getting their second leg. Now it's a tight trading range and also late in the day. So what happens here? We've gone outside up. The bears are trapped below 75. It's a trading range. There's probably sellers above, but we've gone sideways for so long at this point through here that it's a trading range. It's 50-50. The bears seem to be failing to get their second leg. They had an attempt here. They failed. They had another attempt here. They failed. They got a small second leg, but not the big second leg they wanted. And then 75. If you sold below 75, you're trapped. 76. 76 will probably get a second leg up, but the upside might be limited. There's resistance here. There's resistance at the trend line. Resistance at the 49 low. And you can see the market's reaction to those prices. And just quickly through here, let's look at a 100-second chart. I was showing this on the 5-minute. So this highlighted area, see if I can do this better. So this section right here is this here. I said this is a bull breakout of a bull channel line on a smaller time frame. This being the channel line. Let me see if I can turn on the bar counter. All right, that might do it. So bar 60. So this is what I'm seeing on the 5-minute chart. Over here, the big screen is the 100-second chart. The top right is the 5-minute. And you can see the doji, another doji, and then a big trend bar. And it's a bull channel on a smaller time frame. The 100-second chart shows the smaller time frame. So it's a bull breakout testing the channel line. And it's 2 legs up, 1 pullback, 2 with a late leg nested, 1, 2, 3. And testing resistance over here. testing that lower high. And then here. So that's why I thought 62 was a better sell to close bar, but it hesitates. Maybe you give the bar 1 to 3 bars to work. You want to get maybe to the low of the signal bar, and it starts to fail, and you just get out. But you basically get the same signal a few bars later here. This time the pattern covering more bars. So maybe that's the channel. You have this big bull trend bar. This is the 5 minute in the top right again. Big bull trend bar, but clearly a late leg, 3 legs up, and a lower high to the left. This big bear breakout and tight channel is probably going to get a second leg down. And that's why I thought selling 65 is also reasonable, because what's more likely? Is the market going to rally? Let's see if I can draw this. Is the market going to rally for 1R of that bar before it tests the low of the bar? Probability is that with the late leg against a strong breakout, so probabilities favor a second leg down. Probability also favors that a third leg in a channel evolves into a trading range. And if this is a channel against a trend, so bear trend and then a bear flag, bull channel, bear flag, probabilities favor the second leg down more to the downside. So we're probably not going to go for a measured move of this bar before at least pulling back, and then a small entry bar. That's disappointing. That's bulls showing a loss of momentum, and you can see the result. I change that back to the 15. Change this back to the 5 minute. And that's going to be it for today's end of day review. So thanks everybody for watching and listening, and I hope everyone has a great night.